Hi class, in this we're going to go over chapter 5 in your textbook. So the topic is on elasticity. So before I talk about this topic, elasticity, I want you guys to think about the word elastic. What does elastic mean to you, right? So think about yoga, right? So you guys, maybe some of you guys try yoga before, so really how flexible you are. Elasticity or how elastic you are also measures how flexible you are. So the example in the book used the company Netflix. So as you guys might have already know that Netflix right now actually have different pricing plans. So there's the cheaper one that have the advertisement. There's the standard one that has no advertisement, and then there's the more expensive one that actually allow you to use multiple shared devices, right? So different prices for the same kind of services. And the reason, why is that? Why is company willingly charging different prices for different consumers? And this has something to do with our elasticity, or how flexible our consumer and business are to any type of changes. And in this case, this will be the price change. So let's talk about definition. So elasticity, so it's an economic concept that matches the responsiveness of one variable change to another variable. The most common elasticity we're going to learn in this chapter is called a price elasticity for demand. So this measures whenever the price changes, how much does our quantity demanded change? That is our price elasticity for demand. So this concept here is very close related to our law of demand. Remember that we said according to the law of demand, whenever the price increases, quantity demand would decrease. Whenever price decreases, quantity demand will increase, right? So between price and quantity, we expect to see an inverse relationship between the two variables. So what the elasticity actually measures, we know that quantity demand will change whenever price will change, but elasticity will tell you how much of the quantity demand will change whenever price changes. So it depends on different variable, the quantity demanded are behaving very differently, right? So for some good, consumers are more sensitive, then we tend to see bigger changes whenever price change. Or maybe for other good, the consumer have no choices, then whenever price changes, we might still buy the same amount, right? So how much of this quantity demand is changing, that's measured by our price elasticity for demand. And on the other side, we have the price elasticity for supply, which is the same measurement, but we're now looking at whenever the price change, how much would that change our quantity supplied in the market. All right, so whenever this measurement, whenever the elasticity is more than one, we call this type of situation elastic demand or supply. Whenever it's less than one, this is called inelastic, and whenever it's equal to one, we call this unitary elasticity or unelastic. So whenever, let's say whenever demand is elastic, that means consumers, we care about the price change. We are price sensitive. So whenever there is a price change, then quantity demanded will change more than how much the price changes. So imagine we might have a 10% change in our quantity, and then divided by a 5% change in our prices, and that's two, so that's more than one, and that will be called a elastic. So the formula for the elasticity is just very simple. We're going to use our percentage change in the quantity divided by the percentage change in price. Now again, if this is positive, more than one, we call this elastic. Equal to one is unelastic. And lastly, if it's less than one, we call this one inelastic. So for inelastic, let's say for demand, when demand is inelastic, that means consumers, we don't care about the price change that much. Whenever price changes, we're going to change behavior, but only by a little bit, right? So think about something that consumer absolutely need to have, like the basic necessities, bread, milk, egg, sugar, right? So whenever price changes, so imagine the price doubles for those goods, we're still going to buy them, but maybe just at a very slightly less amount. So that will be a very small change, and that's called an inelastic. So to measure elasticity, we're going to use our Maypoint method. So Maypoint method, this is the long formula. So remember, our elasticity equals to the percentage change. So the triangle stands for change of quantity demanded, and then divided by the percentage change in prices, right? So this is the two-part formula. When using the Maypoint method, the top portion, the percentage change in quantity, is this thing right here, and then the bottom portion will be the lower one, P1, P2 minus P1 over P2 plus P1 over 2. Now the benefit of using the Maypoint method is that it doesn't matter which point comes first or second, your answer will be the same. But you have to be consistent. So if you're using, let's say, let's suppose we have example, uh, let's call this one point A, and this will be point B. And let's suppose for this one, price is $5. For this one right here, price, let's call this one $3. And then for the two quantity, we're gonna have a 1, and we're gonna have a 2. So if you're gonna use this information here and then apply our Maypoint method, let's talk about our quantity first. So for quantity, that's the number 1, number 2. But which one is Q2? Which one's Q1? It doesn't matter. It doesn't matter which one Q1, Q2, your answer will be the same. But the very important part is that you're going to be very, very consistent. So if you decide that this number 2, that's our Q2, that means this corresponding number 3 will be your P2 as well. And then also if this A, if your number 1 here is your Q1, then the corresponding price is 5, that's your P1, right? So it doesn't matter which one comes first or second, but make sure you're being consistent about which point comes first or second. Now, for now, it doesn't make a difference, but later on when we study, the income elasticity, the cross price elasticity. If you get the points mixed up, then at the end, your signage is going to be different, right? So everybody else might have a positive, but you have a negative. That's because you got the points mixed up, right? So make sure be very consistent. If your point B is number 2, then point A must be number 1 for both price and quantities. All right, so here's some examples here. I'm not going to go over this. You guys can look at it, practice. So try the numbers here and then use calculator, find out what the answer is. And then one thing you might want to do is that you might notice that in some of the questions, the example tend to round the answer to 1 decimal or 2 decimal in the middle, to be consistent and also to be exact with your numbers. Whenever you do a question like this on your quiz, only round your answer to 2 decimals at the very last step. So right here, you're gonna round for 2 decimals. But anywhere in the middle, so the 7.4, the 26.1. Now guys, I want you to take as many decimals as possible. Take on like a 5 or 6 decimals. Because if you round your answer in the middle, so at 26.1 or 7.4, if you round the answer here, once you get to the end, your answer will be just a little off. So imagine the right answer might be 3.53, and then you're gonna have like a 3.52. For multiple choice questions, that wouldn't matter much because you're gonna choose the closest answer. But for the math questions on the test, you have to be exact with your number. So even though it might be just be like a off by 0.1, you're still counted as wrong, right? So definitely try to keep your answer consistent. Try to take on many decimals possible in the middle of the question. Only round it for 2 decimals at the very end. Okay, all right. Next, let's talk about some special cases. So whenever you see a flat demand curve or flat supply curve, now this is a special cases. Normally we don't see this. So you haven't seen this here in your chapter 2, 3, and 4, but now we look at it, right? So we have this flat supply demand curve. This situation is called this is called a perfectly elastic demand. And what that means for consumers or business, we are very, very price sensitive. So when the price increase a little bit, we don't have demand or supply at all anymore. So if you look at this demand curve, so that's only at this one price level. That means if I increase price just a little bit, like over here, it doesn't intersect anywhere to our demand curve. That means the price only increased by a little bit, our quantity demanded becomes zero, right? So that's called a perfectly elastic demand curve. The consumer care about the price changes. When the price changes a little bit, we don't buy them anymore. Now the other extreme is whenever you see a vertical demand or supply curve, and this is called a perfectly inelastic. Then that means consumers or business, we don't care about the price change at all. Doesn't matter what the price is. So price is high, price is low, we're buying the same amount. So quantity never change. Doesn't matter what kind of prices we have. So in these examples, the consumers think about maybe the very basic necessities. Think about stuff like chemotherapy drugs or insulin, right? So for those patients, they need those drugs, right? So whenever price changes, those patients don't change behavior. We buy just what we need. So at a higher price level, at a lower price level, we buy the same amount. And that's called a perfectly inelastic demand. And then the other one we learned earlier is called a unitary elasticity or unelastic. This happens whenever elasticity is equals to 1. So your change in the quantity percentage is equal to the same of your change in the price percentage, right? So if you look at between here and here, notice they all changed by 66.7%. So here, between these 2 points, between B and C, your elasticity equals to 1, and that's called a unitary elasticity, right? So the changes in your quantity is matched with the changes in your price. And then for supply, same thing. Notice that from here and here, your supply, the price and quantity changing by the same amount, and that is again called a unitary elasticity. So for most companies, every day they're facing with different choices, right? And the most difficult choice is, what price do I charge? Now, you as a company, you might be thinking, hey, I want to charge a higher prices. Why not just charge a higher prices? Because as we commonly believe that if we can charge a higher prices, that's good for the company. But remember, for our consumers, between price and quantity, they're moving in the opposite direction, right? So if the company decide unitarily to increase the prices, this will cause a decrease in quantity demanded. That might actually hurt the company, right? So there's a very tricky balance here on just how much price we can charge, and that depends on the elasticity of the demand in the market. So imagine that we have a situation where a company achieved a lot of improvement technology. And now company have a choice. I can pass on this saving to my consumers by offering lower prices, or just keep all the profit to myself. Now it depends on different type of demand curve. That result is very, very different. So imagine both scenario here, we see a supply curve shifting to the right. So that's an increase of supply. Now we are going to see a price decrease and also quantity change. Now if your demand is very, very, very inelastic, so this right is inelastic. You see how that when the supply shifted, that our quantity only changed by a little bit, and then price went down by a lot, right? So in a very inelastic demand, company will pass on the saving to consumers. But vice versa, if the demand is very, very elastic, then when the supply shift to the right with a very elastic demand, we're going to see a very small price change, but that comes with a big quantity changes. So when the demand is elastic, then company, they can keep a bigger portion of this cost saving to themselves, and then pass on only a little bit to the consumers, because to sell more, they don't have to change price by that much. But in a very inelastic demand, company had to change the prices by a lot. So change a huge price change to cause a very small quantity change, right? So that's different between our elastic and also inelastic demand. Now, vice versa. Let's suppose we have a higher cost. Suppose we have an increase in taxes. So increase in taxes, we're going to see our supply curve shifted to the left. When the supply shifts to the left, if you have a very inelastic demand, then prices will increase by a lot. So in the example here, we use the market for a cigarette, right? So for those smokers, they're very, very inelastic. They have to buy the cigarette. So in that case, if you put a tax on the business, then company will pass on this tax to the consumers. So price will be increasing by a lot whenever there's a higher cost or increase in taxes. Now, if it's elastic demand, so consumers were very price sensitive, then if the cost increases or tax increases, then company will be more than likely to absorb this increase in cost and only increase the prices by a little bit, right? So again, depends on your different elasticity for demand, how much that cost is either passed on to the consumers or being absorbed by the business is very different, right? So if you have a very inelastic demand, then the cost will be passed on to consumers. And if you have a very elastic demand, so consumers have choices, then companies are more willing to negotiate and then take on higher cost than the consumers. All right, so also know what's a tax incidence. So this is how much is the tax burden between our buyer and sellers. And then one thing you want to ask yourself, so between buyers and sellers, who pay a bigger portion of the tax? So who decide that, right? So it's not government. Government decide what the tax is, but government doesn't decide who pay for the tax. But if you think about it, that's not what we commonly believe, right? Because if you think about our sales tax is being paid by the consumers, right? So think about if you're in Houston, Texas, then your sales tax in Houston, Texas is 8.25% of the purchase price, right? So of course, our consumer pay for it because every time you go to check out, it's on your receipt, it's on your it's at the register, right? So you are paying as a consumer, you are paying the sales tax. But sometimes you also hear, advertisement in the radio, on TV says, hey, we're a new suppose hey, we're a new furniture store and we have a special promotion, and then for this month we're gonna pay for your sales tax. So any idea why would a company want to pay for the consumer sales tax? Well, that is because when they pay for your sales tax, you're gonna still buy the furniture from them. But if you don't buy the furniture, then they don't get any profit. So a little profit is better than no profit. And that's why companies have an incentive to share this tax between the buyer and sellers. So that's why tax is always shared. Now, who decide or what decide that who pay a bigger portion of the tax? That is elasticity. So between buyer and sellers, whoever is more inelastic, so you are not flexible, you are inelastic, then you're going to pay a bigger portion of the tax. And whoever is elastic, so you are more flexible, then you're going to pay a smaller portion of the tax. Okay, so again, inelastic pays a bigger portion, elastic pays a smaller portion. And then if you look at this diagram over here, so for the first diagram, we have elastic demand, inelastic supply. So companies are not very flexible, but consumers are very, very flexible. Now, if you're flexible, if you're elastic, that means you have more choices, right? So if you are forced to pay a higher tax, you can go somewhere else. You're not buying this good anymore. So in that situation A over here, if you have a higher elasticity, For the demand, then demand gonna pay a lower tax. So if you look at this little shaded area, the top rectangle, so this area here, that's how much tax paid by the buyer, and then the bottom rectangle, so this area here, that has been paid by the seller, right? So seller paid a bigger tax than the buyer because sellers in this situation are inelastic. Now, if you reverse it, if you have a very inelastic demand, but a very elastic supply, so now become the buyer pay a bigger portion of the tax, and then the seller pays a smaller portion of the tax. Okay, so between buyer and sellers, whoever is more elastic will pay a lower tax. Whoever is more inelastic will pay higher taxes. Now for long run, short run, between both buyer and sellers, we tend to be more flexible in the long run, but inflexible, or is that even a word? Inflexible, unflexible, or inelastic in the short run. Right? Because in the short run, we have less choices, but in the long run, both consumer and business, we have time to respond to these changes and become more flexible. Right? Think about, let's say, the price of gasoline. Let's suppose next week, price for gasoline doubled. Now, for next week, can you go buy a new car next week? Well, maybe not, right? But what if the price for gasoline is doubled for the next 10 years? Would you go buy a new car in that time? Sure you will, right? So in the long run, consumers have more time to respond to the changes, then we're more flexible, elastic. But in the short run, we have less time to respond, then very, very inelastic, then we cannot change our behavior. All right, so for oil, for crude oil or gasoline, this again depends on elasticity. So anytime there's a supply shock, if you have a very, very inelastic demand. So the first one here, this is inelastic demand. So demand is almost like a vertical line. Then with a supply shock, we're gonna see a huge increase in the price of gasoline. Well, that's because our consumers, we don't have choices. We have to buy the gasoline, right? So if that's the case, you're gonna pay a higher portion of the prices change. Now vice versa, if your demand is more elastic, so consumers have more choices, we don't have to buy the gasoline, then with the same change in the supply shock, we're gonna see a smaller increase in the prices for gasoline. Now again, this goes back to what we were talking about before, is that this cost, this higher cost, is able to pass on to the consumers when they are very, very inelastic. But when consumers have more choices, we can have maybe other means of transportation, or we might be driving more EV, so electrical vehicles, then a supply shock in gasoline could have very minimum changes in our prices of gasoline. Because, again, consumers are more flexible, then companies will be responsible to eat up many of the supply shock. All right, so let's look at two more elasticities. So this one's called an income elasticity for demand. So very similar formula. We're using the percentage change in quantity demanded divided by the percentage change in income. Now for this number here, we care about the signage. Now remember what we learned in chapter 3 about the different type of good. This whenever you have an income change, remember the normal good and the inferior good. So whenever this income elasticity is positive, then this is a normal good. And whenever it's negative, then this is an inferior good, right? So be careful with the signage. We care about the signage, whether it's positive or negative, will determine if it's a normal good or inferior good. And next, it's called a cross price elasticity. Now for the cross price elasticity, we're comparing the price of one good, so good B, against the quantity of good A, right? So we're not looking at the same good anymore, we're looking at different good, right? So between the price of good B against the quantity of good A. And again, we care about the signage because for cross price elasticity, that we are arguing or we're indicating that whenever the price of good B changes, this will cause a demand change in good A. Now remember we learned in chapter 3 between complementary and a substitute good. And that's what it shows you. So again, we care about the signage. So if this is positive, so if your cross price is positive, so imagine if the price for good B is getting more expensive, at the same time, demand for good A also increases, then this two good must be substitute good, right? Because if B is more expensive, then consumers are buying less B and buy more A. So you're gonna see a positive cross price elasticity. Now, if this is negative, then this must be a complementary good, right? So if good B is getting more expensive, so in return, consumer buys less good B, at the same time also buying less good A, then that's a complementary good, right? So signage matters now. Positive means substitute, negative means complements. All right, so a couple more. So this is what you learn in chapter 4. So we can also use elasticity to measure the wage elasticity of either labor supply, labor demand. So similar formula. Only thing we change is the quantity of labor supplied versus quantity of labor demanded. And also what we learn in chapter 4, the interest rate on the financial capital. So your financial saving measure against interest rate versus financial borrowing measure against interest rate. All right, so let's go back to our questions before, right? So Netflix, right? So Netflix had different price levels. Now, what you have in the PowerPoint, this is a little outdated information, but what you probably know is that Netflix, the reason why they're having a different tier of pricing is try to meet the demand of different consumer elasticity. So if you're a consumer who doesn't care that much about Netflix, so you're like, I'm okay. It's nice to have a Netflix account, but I don't watch that often. Then you tend to be more flexible, elastic. Then Netflix is going to offer you this lower price choices, right? So Netflix using with advertisement that's cheaper. Vice versa, if you love Netflix, that you are a huge fan of Netflix, then you are willing to pay higher prices. So you're going to end up paying the premium cost for Netflix. So the reason why companies have different tiers, different pricing model is to meet the demand for different consumer elasticities. Okay, but also one more thing to add, Netflix is struggling big time. And that's because there are more companies competing against Netflix, right? So Amazon Prime, Hulu, Disney's, NBC, Universal, or what's it called, Peacock, right? So all those new services are competing against Netflix. So the consumers who are still with Netflix, their elasticity is keep increasing because now there are more choices to purchase. Okay, so that's it for this chapter, guys. Hopefully you're okay. So there are a lot of math questions for this chapter. So definitely be careful with your elasticities. Use a calculator. Don't use your head. Okay, and also when you put your number in the calculator, do it step by step. Because if you try to put everything in the calculator at once, you can get it wrong. So do step by step, and also only round your answer at the very last step. So in the middle of the question, take on as many decimals as possible. Take on like 5 decimal places in the middle. At the end, run it for 2 decimals. Okay. All right, guys. That's it for this chapter. Any question, let me know, and I will see you guys for next chapter. All right. Bye bye.